The SRI industry today is in excess of $3 trillion. It has been growing rather fast, around the same numbers, about 20-25% per annum. I think the pendulum has swung towards more about climate change, about environmental factors. Major pension funds in the US are very concerned about corporate governance and the sustainability of corporates and their corporate ethical practices. So, for example, in the oil industry, oil spills, record of an oil major is an important aspect that should be controlled. It should not happen so frequently. How mining sites are restored after the mine deposits have been exhausted. All these are some of the issues, and thematically the ability to manage and how the corporate behavior, I think, is being influenced, is becoming more and more important. It's all about, at the end of the day, the impact of climate change and environmental factors that are now become of concern to institutional investors, namely the pension funds, the fund managers, the insurance companies have all actually sat up and taken notice of it, and hence the SRI industry, referred to as socially responsible investing, has been growing at a fast clip. It is definitely sustainable, provided the right kind of opportunities are available for the investments which are coming into the SRI industry, and the returns that are generated from that investments are equal to the expectations of the institutional investors. So, in other words, that like any investment, the investor is looking for, whether it be Islamic finance or whether it be socially responsible investing, they're all looking for a return consistent with the risk that they are taking. And therefore the return aspect is also important. But I think socially responsible investing, whether it be a water fund or whether it be, I've seen a number of funds being done, or whether it's a fund to actually produce climate change, are becoming more and more prevalent from major fund managers in Europe and the United States. Ethical investing is based on a set of parameters which are tested before an investment is considered to be acceptable. Now, those parameters vary from one provider to another, but there is a common consensus around ethical finance that, for example, the tobacco industry, the gaming industry, the to some extent the drinks industry, these are industries in which ethical investors generally are not investing. So there are certain segments of the industry which are considered to be out of bounds, if I may say, whereas others are considered to be acceptable. And the whole thing about ethical finance is that it is again on poise for growth, because the institutional drive for getting best practices from corporates and getting their behavior aligned with corporate ethics is becoming more and more important now. At the end of the day, negative screening was passive, positive screening is more proactive. It's also articulating the message to the investor that there is actually a lot more work, due diligence being done on positive screening. And the positive screening factors give the investor a lot more comfort about the way their investments are being treated by the fund manager or by the financial institution to whom the money is being entrusted. And hence I think the positive screening is going more in that direction.